Good morning. My name is Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Jill Malandrino with TheStreet, and together we bring you the morning call. Happy New Year, everybody, and particularly to the bulls. What a day they had yesterday. All three indices with incredibly strong performance. So what we're looking for today is there more room to go? Are there good entry points? Are we looking for some consolidation here?
I think digestion consolidation is what we should see probably heading into the jobs report on Friday, which is tomorrow. We had even more than a great move yesterday. The move started actually Monday. Started Monday morning when pre-market, we tested the 200-day and held it, and then we took back 1401, closed strong on Monday, and then we had follow-through yesterday based on the fact that we had resolution to the fiscal cliff. So it's kind of funny that now, every headline's been market up because of optimism of fiscal cliff, market down, blah, blah, blah. Now, I think the next, obsession is going to be the debt ceiling. But I'm just hoping that guys that trade the equity markets or people at home don't obsess over it. Right. It's going to happen, okay, and they're going to have resolution to it at some point. Hopefully we get a lot of spending cuts because we just raised taxes, so I think we do need that combo. But overall, the market should get by it. When the market's overbought enough, that's when probably we'll pay some attention. But I do think that after a bit of digestion, we'll have more room before actual market participants obsess over that next.
I think 2013 is really going to be the year of the stock picker. Regardless of the fiscal cliff, there are some great charts out there, and the fundamentals seem to be lining up. And I think that's what you really need to identify those out and underperformers to find the opportunities. Before we move into the sector spotlight, let's take a look at some of the daily numbers and monthly numbers leading to some of your pivot points.
Yes, and for those that didn't want to take any risk because they weren't sure if we were going to get a resolution to the fiscal cliff, they're wondering how do they get in. So this is how you get in. You get in when markets digest. You get in when you have sideways action so you can see where the money's flowing. If you take a look at the chart, I'll do the spiders first because you could see, a very nice gap yesterday. So here was Monday, okay, that's when we held above the 200-day. That's also, you take a quick little look here, the Fibonacci retracement from the November 16th low all the way up till, that high that was in December. We held above right around the 50% retracement, which shows you commitment to that move. Let's take it away so you don't have the noise there. So all of a sudden, gap up, and this is the level to trade against. 144.73 is where the gap starts. As long as we hold, I would say 50% of this gap and let these moving averages catch up, I do think that into that dip area, you buy some of your favorite longs. Then once we hold this gap for a few days or so, and then we start to take out 146.15, that's when you add for momentum. And then your next spot on the micro or intermediate chart is right here at 148.11, which is 1474 in the S&P cash. And now if you take a bigger look at the monthly chart, because everyone again, obsesses over the market, how equities are dead, blah, blah, blah. Meanwhile, it's been about 12, 13 years to absorb a massive move from all the way here back here. So this is normal. 95 to where we were in 99. Big move, and here's your digestion as we've sorted through lots of, obsessions, so to speak. So here we are, right at this last little wedge, above 1474. Then you have here the high, which is 157.52. I think at some point, maybe going into, mid-year, we will be testing it. I'm not sure if we're going to be able to take it out mid-year, but maybe by the end of the year, if we take out 1575 in the SPX and negate this double top, we'll be on the road to that 170 in the spiders, 1700 in the SPX cash. If it doesn't happen this year, I do think it could happen with, my thesis last year was the road to 1700 by 2015. Everyone, all the bears are saying, oh, but Europe's going to implode, China's going to have a hard landing, we're going to be at S&P 1000. I think a macro strategy to see the destination is there, and what we like to do is we like to trade the intermediate trends to navigate that long-term destination.
Moving along to the sector spotlight, we are going to check the temperatures of the sectors. Let's kick it off with XLF, the financial ETF, which had a pretty good end to 2012, and a lot of market participants are expecting that momentum to continue into 2013. Your names like your Goldman, your JP Morgans, your Citis, and even name like a Bank America, which is quite the talk of the town.
What do you mean even in there? Like, come on, that one was up 100% last year, and it was another 25% I think in December. But anyway, you're right. The banks have been a headwind, so it's such a nice thing for them to be, wind in our back, so to speak. And if you look at how it kicked off last year or this year, yesterday, you will see that it gapped up above prior resistance, which you saw in the spiders. We're not above 1474. You look at the chart here at the XLF, this gapped up and held above the recent highs here, which already took out the old highs. So showing relative strength still riding the 8-day to 21-day. So if, we talk about the gap, here's your gap to trade against 1674. But then I have to show you this monthly chart. I was looking at it yesterday, and I was like, wow, look at the monthly chart. On the monthly chart, the XLF is just knocking on the door of this resistance, knocking on the door. So I even think there's a small chance that we get up to, test this 20 on the XLF, which would be a hell of a move for the banks to participate with.
Well, if the housing recovery continues on the momentum that it's on, it's certainly going to get some support from that as well. Moving along to the XLI, the industrial ETF, we're also going to look at some individual names when we dive into the trenches. One of the themes that Scott and I are focusing on for 2013 is the increase in CapEx spend. We need to upgrade a lot of technology. We need to upgrade a lot of equipment. The industrials are certainly going to participate in that.
And if you look yesterday, they gapped up, closed strong above last year's highs. So what you want to do is you want to see the groups that were strong last year, if they all gapped up above last year's highs before the S&P, because the SPX highs is 1474, that shows you money is going there first. You look at the chart of the XLI and you will see, look how it gapped up. Didn't close on the dead highs, but who cares? Above the prior pivot, so here's your pivot to trade against. 38.55, that's where the gap starts. This is a big gap. Maybe it goes below this and fills a portion of it, but the longer it holds a majority of this gap, the higher the percentage that it continues higher. And you look at the monthly chart here, even better than the S&P, okay? Look how close this is to, you have the peak right there. You almost have your double top right here. So XLI takes out this 38.96, okay, which it's, 15 cents away.
Right.
Then you have the all-time highs in the XLI, which is 42. So again, lots of things to like here in this market if you're willing to learn how to find them.
Well, another thing, I'm going to throw this one in there real quick, the EEM, the Emerging Market ETF, which is another theme that Scott and I are focusing on, where that emerging market exposure is really what I think market participants are going to focus on this year as well, particularly with the Chinese exposure, because that market seems to be continuing to improve.
Right, and everyone was so worried about the hard landing, and it wound up being whatever landing. Over the summer, talked about the FXI. I remember it was in early December, DeMarc made his call that he thinks the Shanghai bottomed, and we agreed with that call, saying that entries and exits matter, and they've had they were up 3% for the year, but they were up almost 15% for the month, so it shows you that if you find that intermediate sweet spot, you could definitely create some alpha to your returns. And now if you look at EEM itself, this is the monthly chart. So we just cleared this little wedge pattern, and look how these patterns all repeat themselves. Here's your wedge pattern, nice and tight, just resolved to the upside. You have a short-term resistance right here, which we'll be coming into. And then later this year, if we continue to see some type of recovery, you have your big long-term descending trend line, that could be definitely at least challenged. Whether it takes it out, we'll figure that out later this year, as there are a lot of trades between now and then. Well,
our January 43, half 45 call spread worked out really nice for us. So Happy New Year, Scott and Jill. Moving along back to the home builders, let's take a look at the XHB.
All right, XHB, different than what we just saw with the XLI or the industrials, because it got so battered and bruised during the whole market decline. But last year, we were early. We started talking about the home builders. I was on Kramer's show talking about in January, I think, or February, that we're seeing a big move in these home building stocks. That means probably really good things for the overall economy and for investors in this bean down group. So if you go to the daily chart first on the home builders, you will see that to talk about trends continuing. You see how now it's above all the moving averages. Didn't get to the 200-day like the S&P, so showing you relative strength. You almost take out that little outlier below, and it's still following this trend. And then what did it do yesterday? Gapped above the prior resistance and held up above it pretty well. So the longer it stays above this, I think the more momentum for this group. Just to show you quickly the XHB just versus spiders, because again, look where the spiders are versus the September highs. I just showed you the industrials and the home builders and the financials above that high. So that's been a place to be. And if you want to let's show them a quick laggard group.
Right, the RTH, the retail names, which did show some relative outperformance, but in December they completely fell off the charts.
Yeah, they got a little choppy. Even I think before then, they showed some damage when Walmart started to come off its highs, and Target and some of those things. So, that just shows you how people how do you find out where money rotates? Well, look now where RTH was such a stellar performer the first half of last year. Look where this is. Okay, first of all, this closed not even near the highs, in the middle of the range, just trying to take back some moving averages. This came all the way down to the 200-day also, and look how much congestion it has in front of it. So this shows you that this is not where the relative strength is. This is not where things are moving cleanly. So you put this on the B and the C list, not the A list, to see if it could change a little bit. And
let's just wrap it up with the Qs real quick, because again, in 2013 with that CapEx spend, tech is definitely going to get a bid off of that, and a lot of these names have that significant emerging market exposure. So while tech got beat up a little bit in Q4, I think we're going to start to see some momentum pick up going to the first half of this year.
Right, and we'll see if some, Apple, we'll see if some of the mega caps like Cisco was just upgraded today. Meanwhile, it's had a hell of a move. See if maybe Intel, some of the big dogs need to participate in order for the Qs to act better. And so far so good. If you look at the chart here, this was one of the groups that closed near the highs. It's closed near the highs of the day. Big gap up. And now if you look right here, look at this engulfing day, by the way, on what's it called? On Monday. We talk about the 200 day. We talk about how sometimes it's a seller's trap. So we broke below it. Some people got stopped out, and I say within 2-3 days, if it doesn't take back the 200 day, it can continue lower. But if it does, that means there are a lot of sellers out of the way, some shorts trapped, and boom, here you go, close through it, closing the highs, gapped up above this gap. You know what this is called almost? This is called an island bottom. Okay, you go like this where you have a gap here and then a gap above. So look in the middle here. That means all these people down here are trapped. You have trapped people who sold their stocks, and you have trapped shorts. Anyway, gapped up. Here's the low to trade against, same type of pivot, 66.48. The longer we go sideways above this area, the higher the probability, we take this out here and we continue on the road back to last year's highs, which, it's going to take a lot of work to do, but at this point, it started off on the right foot.
All right, we're going to go into a quick commercial, and when we come back, we'll dive into the trenches.
Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to... Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Welcome back to the morning call. We're going to dive into the trenches and head back to the industrial space. Let's kick it off with CAT. There's been a lot of talk about this name. With the fiscal cliff resolution, we're going to see some construction spend pick up in 2013. This is a seasonal trade. November to April tends to be very positive for the industrial groups. I think that in conjunction with some other of the fundamentals and the chart starting to look a little bit better,
yes,
you might have an opportunity early here.
Yeah, I think traders are going to see if some commitment continues. Last year, Caterpillar was a disappointment. It showed relative weakness all year. If you look at the chart here, you will see that, we just talked about the 200-day and the significance. It put its high in last February. Then did a lower high. This is where it broke out from last year going into the new year, and then it should have held. It broke the 200-day, never reclaimed it. So right there, like I showed you in technology prior, if it breaks below it, comes back above it, it's a seller's trap. This wasn't. This was a clue to get out of Dodge. And from there, it went all the way down to the low 75. So now let's fast forward to where we are now. It's not quite back, so to speak, but you do have a gap, right? So you want to trade against that gap, so you want to look at it closely. It's right there, okay? Big gap. Engulfing day Monday, didn't close on the highs, which is fine. So I want to see if it holds at least, I would say for a Caterpillar to really have some pent-up momentum, I would really hope that, it stays above 91, or even above 92. But your pivot right here on Caterpillar is yesterday's low, which is 92.95, and then just let it go sideways, let it hold some of the gap, and then potentially, it'll be on the road to recovery for what could be some higher prices this year, where last year a lot of people were definitely disappointed. If
you're looking for more consistency, a name to look at is Eaton. It continually improves on revenue and earnings, trading above its 50, 100, and 200 DMAs. This is a name that I think would not only good core portfolio holding, but there are some momentum trading opportunities as well.
Yeah, this one I think you guys have talked about a lot during the year. And
the Action Alerts portfolio.
Stephanie likes it also, and this is one I'm going to go, oh, look, this is above moving average. This is rewarding investors. This doesn't have all the supply in front of it. And if you look here at Eaton, you'll see that it looks really good. Look at it compared to Caterpillar. This, actually I think made highs yesterday. So, if you stuck with this one because it's been following the 8-day moving average and it's above, the 21-day moving average, you've gotten paid. So at this point, it is a little bit extended. Okay, so I would just, tread lightly, hold some, but I don't think it's initiate right now because of the move it had. But keep watching it to continue the strength there.
Moving along to DuPont, ticker DD. This is one of those names that sports a 3.8+% dividend yield. Revenues continuing to grow. Valuation is relatively cheap. So this is one of those names where sort of everything is pointing well fundamentally.
Right. This is one of those where it's going to have to prove itself because last year was a tough year.
Right, but it has the ag exposure, which could be big for 2013.
Right. So we want to see if money rotates here and stays here. And one way to do that is to measure the commitment. And if you look at the chart of DD, you'll see that, just like Eden was all the way at the top end of the range, this one is all the way at the bottom. You have a huge gap here also. It's below the 200 days, so it's got some work to do. So if you want to take a closer look at it, if you bought it involved, I would say for it to show a changing character, it's got to hold above 44.55. Go a little sideways. And then if it does that, I think traders will get a little pumped up because you have a really nice gap. And we know when stocks trade in that gap, sometimes it gets a little frisky. So I would say a little commitment over here. And then if it can get above 46.27 and close in this gap, you could see it at least test a 200-day, which would be a decent move for traders and some bottom feeders.
And let's wrap up the industrials with joy. This is one of those bull-bear cases. From the bearish perspective, it has a coal exposure, but the bulls love it that it has that significant Chinese exposure. So this could be one of those, it could be a great play this year, and it could be good under wrap. There's always an opportunity.
Well, in the beginning of a year, you never know where the relative strength and the flows are going. So this one, which was a laggard last year, but was a darling the year before, people want to see, does it change character? And the way you do it, I sound like a broken record, which I apologize, but this is the way you have to go about it, is look to see how much of yesterday's gap it holds. Can the shorts push it in, or does pent-up buying stay there? So you look at this chart, this one, has also been battered and bruised, but at least this one's above the 200-day and all the moving averages, so it's showing a little bit better relative strength than a DuPont. So I would say here you go, okay? Let it build above 65, and then after a little bit of time, if it takes out yesterday's high, you could see a move to, retest this broken area, which comes in around 73. But overall, these are laggard trades right now that are trying to prove themselves, so you have to watch them very closely, and I think they only warrant a tier 1 investment, not a tier 2 or a core.
Moving along to quick hits for quick cash, we're going to take a look at Apple, everyone's favorite name to trade here. And it's almost like with the Kardashian pregnancy announcement on December 31st. Cue in the iPhone 5S and 6 rumors on New Year's. It's just like, really?
It's like, all I think they need to do is just continue to have the supply for the iPhone 5, which has been, it's an unbelievable. You said you just got it and you love it. You have the iPad mini that everyone wants. You have the iPad everything. But the stock had a lot of problems in the last month or two actually, since my birthday, since my 40th birthday, September 21st, that was the high. A little ironic considering I trade Apple a lot. Anyway, from there, it's technically acted really poorly. Whether it was people selling for, the tax increase, whether it was some funds that had to clear out and close down their doors that had to liquidate, who knows, with the supply constraints, or a lot of reasons why Apple, fell from the good graces and it really became more of a trading vehicle. But at this point, it's trying to prove itself again. If you remember in the end of last year, we were talking, can Apple hold 501 to 505? Will it close below it? Will it have a 4 handle? Well, nobody knew. All you had to do is watch the price action, and it did not break that level. And then on Monday, it finally broke a small descending channel. So if you look at the chart here, first things first, here's that little head and shoulders top that wound up becoming a topping pattern. Here's when we broke the 21-day. Here's when we broke the trend line, and here's when it couldn't find the friend, all the way down to that 505. You had a reflex move back up to test this longer-term trend line, and it failed. Came all the way back down here, and this was major support. And if you take a closer look at this major support, you will see that you had a few little reversals in here that failed, and then finally on Monday it traded above that 515, 520 short-term descending trend line. Gave you a nice day-and-a-half trade where I know I got long in this area. I sold some yesterday, but I still have some. For Apple to change its character, mark my words, it's going to have to stay above 541.63. If it closes below that in the gap, people are going to start saying that Apple was just a reflex new flows move. So I'm hoping it stays above this. I'll stay with it as long as it does and closes above this 541.63. Maybe it's even worth a look to go positive today. But then with a little bit more time, if it can get above this 555 and close with some authority, it will break this long descending channel that's been in place since those September highs. So let's see what happens here. I'm in wait and see mode, but I'm more neutral to positive versus neutral to negative right now.
Moving along to Facebook, to friend or unfriend in 2013, we're reading a lot more about Google Plus, the social network integration. So you have that market share erosion that you have to be careful about. Then we've also been reading some chatter that they might start charging users per month.
Good. Charge them. Get some revenue. They have how many billion users that they have that they're allowed to charge that people use the service. But anyway, this stock got a little bit more constructive in the last month or two when the lockup happened and it was no longer for sale. We had a nice move into the earnings gap between 24 to 28.80. It's been trying to hover higher. You look at the chart here. This is another one of my longs. Take a look. You will see that this is when it broke above the 24 to fill this gap. I talked about gap trades, and this one was pretty exciting. It happened fast. And now, it's building another channel here. Okay, you just had 3 days in a row to the upside, so I don't know if it'll just break above it today. But I would say now, the longer it holds this gap from yesterday and goes a little sideways and hangs out above, just say 27.50, I think the higher the probability we can get a nice juicy trade above 28.50 to 28.70 for a quick move to 30. So this is on my radar, and I think it's worth being on yours.
Moving along to GLD, as the market rose yesterday, stocks soared as well, but the macro ETFs like the GLD really didn't participate with that.
No, and about a week ago the GLDs held big support, 158.5. Then earlier this week it broke above 162, tried to get a follow through yesterday, and it was one of the few groups that closed off the highs. So gold still has a lot to prove. On a monthly chart, it's digesting huge gains over the last decade. Last year was definitely a disappointment, even though there were some trades in there. So at this point, if you look at the chart, you will see, it's got a lot of work to do. Here's where it held this gap from August right into here. Touched it, closed off of it. Then it held higher, showing a little commitment. Here is that little descending channel I talked about, 161.5, 162. And then if you look where it broke down from, that's where it just got rejected from, right around 164. So I would say now, if it could do some work above, just say 162 and go sideways, perhaps it could make another move. But at this point, it's really just a trade if you're in it for the short term. And if you're in it for the long term, then you just have to sit tight and wait to see what happens up here and how long it takes to digest what's been a heck of a move since the GLD was created.
Moving along to Las Vegas Sands, and I love watching you trade this name, but it was announced yesterday that Macau revenue in 2012 rose 13.5%. Analysts expect LVS to do well off of this because it has the biggest presence in the region.
Yes, and recently it hasn't been a darling of the trading world. Earlier in the year, the first half, it was great. It broke above its channel and it went as high as almost 60, and then it broke down, and then we had a little bit of a capitulation low. And now if you look at it, you have another channel here, okay, another channel that it's been trying to maneuver. You did gap above it yesterday. You gapped above the resistance of 40. It did close off the highs. So I would say right now, if you're not in it, I would make sure that it does hold this gap. Use yesterday's low as a pivot, same thing I said before, 47.99. It sounds like a broken record, but if we can go sideways for a little bit here, I do think that there could be a move to at least 54 or so if the bid stays with this market. And right now, this puts it back in the game. Let's see if it continues.
Wrapping up with Mosaic, one of my favorite names for 2012. This one reports before the bell tomorrow morning, and we also have a key USDA report coming out in January 11th. This is one of those names where long-term it makes sense. The population of the world is growing. We need to figure out a way to feed people, hence an ag name. But it's also very volatile, all these ag names. You have the cyclical Q4, Q1 plays. They come back a little bit in Q2, Q3, so there's something there for everybody.
Yeah, except for the long-term investor that's really waiting for it to really trend higher. Like this was a great targeted trade 3 times by you and by here. And we're finally waiting for it to have a sustained move higher. So yesterday, I know it was downgraded midday. It was looking really good and closed off the high. So I think if you look at the chart here, you'll see it just broke this recent downtrend right here on Monday, gapped up, closed off the high, so it's showing it needs time. I'd like to really see this, hold above 56-ish. And you know what? Earnings are tomorrow, you said before the open. Let's get them out of the way. Get the earnings out of the way so this way it could just trade. If it holds up through earnings, great. Tomorrow, sometimes on earnings, they miss and it goes lower, but they buy it anyway. If they do that, that'll be a positive sign. But as of right now, I think your line in the sand comes in right around 55 and change. And if you do not take stock into earnings, or you're a little uncomfortable, put on some kind of collar. Right? Or buy some puts. Sell some calls, buy some puts. You're the genius behind the option world. So what would you do if you're an investor in...
If I already had it on, I'd probably buy some puts. Just so you have some relatively cheap insurance.
Right.
So, and then also from back shifting to the fundamental side again, we have that the Cargill lockup coming off in May. There's going to be a lot of cash put to work in this company, and I think just not Mosaic, but the ag space overall. We're going to have a lot of places that we're going to be able to find in there. On that note, catch Scott at the end of the day as he wraps up the charts for us on Options Profits, Real Money Pro, and T3Live.com.